All right, friends, I want you to picture Detroit in 1950. Not the Detroit we know today, right? Not the one with pictures of empty lots and boarded windows. I mean Detroit at its peak. It was the fourth largest city in the United States and home to nearly 2 million people. That's the census figure. Nearly 2 million people packed into a city that at that point in time was building the machines that largely moved the entire world. The assembly lines ran day and night. And so a kid could walk out of high school and into a factory and start making, good money. Enough money to buy a house, a car, and create a comfortable life to raise a family. Now, the work may not have been the most exciting or desirable at that time. I'm not saying it was ideal, but just looking at the big picture, by all accounts, the neighborhoods in Detroit were full back in 1950. The churches were full on Sundays. It was a center of productive capacity that you could see, you could hear, you could smell, you could touch. And Detroit was not the only one. You had Cleveland and Youngstown in Ohio. You had Buffalo in New York. You had Gary in Indiana. And you had Flint in Michigan. We had this whole belt of American cities where capital and labor just kind of came together to make real things. All right, now fast forward to today. By the 2010 census, Detroit had lost about 61% of its peak population. 61%. So entire blocks went vacant. Factories that once employed thousands of people, they've stood silent, with the roof caving in and trees growing up through the floors. The infrastructure that a generation built, the roads, the water mains, the rail, the power generation and distribution systems, most of it hasn't been touched since. It was not maintained. It certainly was not modernized. Yet these were booming cities not too long ago, and they created a ton of real wealth. So I have to ask, with these cities in shambles today, where did all that wealth go? Because the capital that built those cities didn't vanish. It didn't evaporate. So if it stopped building factories, plants, and rail, where did it go and why? That will be the topic of today's episode. Hello and welcome back to the Phoenician League podcast. I'm your host, Joe Withrow. So to answer our big question today, I think we have to start with something that I've come to realize recently. And that is the very nature of capital in American society has fundamentally changed in recent decades. And here's what I mean by that. For most of American history, capital was something that a person deployed, right? And by that, I mean a real person who was directly exposed to the consequences of their own decisions. So if you had capital and you wanted it to grow, you generally had to finance real economic activity. A factory, a mill, a farm, a local business, whatever it was, it had to do something that created genuine value for society. We're talking about investing in physical things that were located, in a specific place that employed actual people. And that would be judged by a simple test. Did they produce something of value that people are willing to pay for? So I think that was capitalism in the traditional sense. It was an owner making a judgment call, putting their money at risk behind something they could see and something they could understand. Then if they were wrong, they lost money. And if they were right, real economic activity, it increased. Wages increased and things got built and the investor made money in the process. So everybody won. But something changed over the last few decades. It was something of a slow and subtle change. So I don't think many people noticed what was happening at first. But over time, capital increasingly stopped flowing through people who were making judgment calls and started flowing through these indifferent structures. So we're talking about abstract structures like index funds, exchange traded funds, hedge funds, private equity funds, things like that. These are structures that aren't 100% exposed to the consequences of their investment decisions because their business model is to bring in capital from outside, deploy it, and then just take a cut of the action. It's the skim economy. Now, I'm not saying that these vehicles are inherently bad. I'm just saying that their structure is different and they fundamentally changed the nature of capital allocation. So if we think about how an index fund actually works, you put $1 in, that dollar gets spread across the companies in the index, and it's spread out in proportion really in most cases, or a lot of cases anyway, to how big those companies already are. So the money flows to what's already the biggest, and it happens automatically, which makes the biggest things even bigger. And that pulls in more money, which makes them bigger still. So it's kind of this self-reinforcing cycle. And nobody along that chain is sitting there asking, is this company building something real and worthwhile? The mechanism itself does not ask that question because it can't. And so as it stands today, BlackRock, Vanguard, and State Street are estimated to hold somewhere in the neighborhood of 20 to 25% of the total US stock market, right? And they are the single largest institutional shareholder in a large majority of companies that are in the S&P 500. And so the figure you'll see cited most often is that around 88% of S&P 500 companies have one of those three as a top shareholder. That's BlackRock, Vanguard, or State Street. So we have three firms making a large swath of all investment decisions in the largest and most advanced economy the world has ever seen. But those investment decisions aren't exactly intentional. They're more governed by rules-based algorithms. So that the capital just flows kind of automatically. It's largely on autopilot. And again, I'm not moralizing here. I'm just pointing out that it's a machine doing what a machine does. Okay, so that's the first half of the story, how capital got abstracted away from ownership and judgment. But there's a second half too. And the second half is the part that really made the first half possible. And that comes down to the nature of money itself. In the old days, our money was backed by gold. Speaking from an American perspective, you could look at your dollar bill prior to 1933, and it would say explicitly that there had been gold deposited with the U.S. Treasury to back the bill. And going back further in history, our money actually was gold, physical gold. And so having money linked to gold means that nobody can create it at will, right? Nobody can just print more money. It also creates a hard ceiling on how much credit can be created at any given time as well. So that dynamic forces capital to compete for the generally productive use cases, right? If money is scarce, it has to go where it will earn a real return, which means most of the time it's going to go to something engaged in real economic activity. But once money becomes fully elastic, once it can be created by a policy decision instead of being constrained by a physical reserve, that's when the ceiling comes off. So today, credit can expand far, far beyond what real productive capacity would ever justify. And it has, big time. We see that in the debt numbers. So that creates a dynamic where the economy is flooded with cheap paper money or digital money, if you prefer. And suddenly some smart people figured out how to play financial engineering games to enrich themselves without actually enriching society in the process. And I know I'm painting with a very broad brush here, and I know there are plenty of nuances and exceptions. There always are. But if we look at the data, it tells the story directly. All right? If we go back to 1990, the FIRE sector, F-I-R-E, and that stands for finance, insurance, and real estate, it surpassed manufacturing's share of GDP, gross domestic product, in the United States. And that's data that comes from the Global Macro Monitor. So around 1990, making things stopped being the biggest slice of the American economy, and just moving money around became the biggest slice. And now, don't get me wrong here. GDP is a very flawed metric. I don't think the GDP number itself conveys really any meaningful information to us. But financial activity compared to manufacturing activity as a percentage of GDP does tell us something useful. It tells us that finance overtook building stuff in 1990. So sometimes when I write, when I speak, I use the term financialization. And that's what I'm referring to. It's the emphasis on financial activity, kind of moving money around, rather than productive activity. So just please know, I'm not saying that finance is bad. It's not. We need finance to have a complex economy with an incredible division of labor. But the purpose of finance, it used to be to enable real economic activity. Right? So when we talk about financialization, it refers to using finance to kind of game the numbers, to extract an outsized profit from something without increasing economic activity. So in that sense, it is fundamentally parasitic. Now, I'd like to share with you a real world example of what mass financialization has done. And I'm going to tell you what I saw firsthand in the wake of the 2008 financial crisis. So on December 16, 2008, Federal Reserve Chairman at the time, Ben Bernanke, cut the federal funds rate to 0%. And we call that era ZIRP, the zero interest rate policy era. So they used financialization mechanisms to hold interest rates at zero for the better part of 2 decades. Now, think about what a zero interest rate does to all that elastic money that we talked about. When the cost of borrowing money is essentially nothing, there's no cost of capital. If you can borrow money at near zero interest, suddenly it doesn't matter much what you do with that money, at least not from an investment perspective. So that creates the dynamic for what we call a carry trade in investment circles. So if you can borrow money at near zero interest and then invest in something that you consider to be largely risk-free, if that asset can generate a rate of return that enables you to pay off the loan and then pocket the difference, well, you've got a good scheme going there, don't you? So this is why several large firms started snapping up single-family homes across the United States in the years after the 2008 crisis. That's because real estate prices had tanked, right? And so Wall Street had never treated single-family homes as an institutional asset class before because physical real estate doesn't easily scale. But with zero-cost money and new technology to manage thousands of scattered properties, suddenly they jumped in. So by 2015, institutions like Blackstone, American Homes for Rent, Waypoint Homes, Cerberus, and there are, I think, a few others in there, they owned upwards of 300,000 single-family homes in the U.S. By the middle of 2022, that number had grown to roughly 574,000 homes. And in certain southern metropolitan markets like Charlotte, Atlanta, Jacksonville, and I believe Tampa, institutional investors came to control somewhere around 15 to 25% of the single-family rental market in those cities, right? So the total institutional capital deployed into single-family housing over this period is estimated to be somewhere around $100 billion. Well, what did that do? I can tell you from firsthand experience. In 2011, I bought a home in Charlotte, North Carolina. Now, Charlotte, for those who might not know, is the second largest banking hub on the entire East Coast. That's why I was there. I was in corporate banking at the time. That was my first career. So I bought this modest little home for $110,000. It was about 1,500 square feet, 3 bedrooms, 2 baths, 2 bathrooms. Nothing fancy at all. It was a starter home. And I was a young professional at the time, right? It was my starter home. So in 2013, I decided to make my break and get out of corporate banking entirely. And I shared that story with you in episode 3 of our podcast here. So I had identified a 5-acre property up in the mountains of Virginia, and that's where I was going to make my escape. But I needed to sell my house in Charlotte so that I had enough cash to make the down payment, right? Well, it turns out that a company called American Homes for Rent was snapping up homes in Charlotte at that time. And so I put my house on the market, and those guys sent me a cash offer of $134,000 just a couple days later. They never even bothered to come visit the house. They gave me an cash offer, sight unseen. Now, I'd never heard of this company before. I was in the corporate banking industry, but these guys just weren't on my radar. And at the time, I didn't care too much about what they were doing either. I was just grateful for the offer because it gave me the funds that I needed to buy my property here in Virginia. Well, I went back and looked up that same home here recently. It has not sold one time since then. So American Homes for Rent, they still own it. But that home's now worth roughly $370,000, right? That same little starter home that I had paid $110,000 for, it's now somewhere around $370,000. Okay. So the home has appreciated somewhere around 236% in nominal value since 2013. But guess what? Median wages here in the US have only increased by about 57%. So house prices have far outstripped wage growth over this time. Right? And I'm sure that's why American Homes for Rent still owns that home today. No young professional can afford it at current price levels. It's just a starter home, but it's too expensive for people needing the start. And so that's the direct impact of cheap money just pouring into single family homes. It created a financialized market where prices have become disconnected from real economic activity, right? And that's just in real estate. Like the financialization thing is warped, all kinds of really, the entire structure of the economy, not just real estate. That's the example that I saw firsthand. So let's bring this whole thing back full circle here. When capital is directed into bidding up, prices of existing houses or existing stocks and other hot investments, there's something that it's not doing. It's not maintaining infrastructure or building new things, and again, the data tells this story directly. So U.S. public infrastructure spending peaked at around 3% of GDP in the late 1950s, right around the time that Detroit was at its peak, right? Today, it's fallen to roughly 2.5% of GDP in recent years. And that data comes from Brookings. And we should note that nominal GDP has increased dramatically since then. So it's a smaller percentage of a bigger pie. And if we look at public infrastructure spending on non-defense infrastructure, the data is even more bleak. So that fell from about 1.4% of GDP in 1966, I believe it was, to about 0.7% today. So it's roughly cut in half, right? So while institutional capital was busy bidding up the price of, say, my little starter home in Charlotte and countless others like it, the infrastructure in those old industrial cities was neglected. It wasn't touched. And so here's another data point that I think is very telling. And for those watching the video version, this is a chart of American productivity, the output of goods and services. And it's mapped against real wages in this country, right? Inflation adjusted wages, what American workers actually get paid. And so if you're looking at the chart, the two lines, they moved in tandem for the entire post-war period, early in the 20th century. As workers produced more, they got paid more. That was the deal. That was the American economy working the way it's supposed to. But the two lines diverged in 1971. Productivity kept climbing, but wages flattened out. Americans kept producing more and more, but their wages, when adjusted for inflation, they stagnated. So what happened in 1971? That's the year President Nixon closed the gold window, the last remaining link between the US dollar and gold. And so that's when the US dollar became 100% elastic, 100% fiat. Of course, we can't assume causation here. It would not be fair to say that decoupling the dollar from gold is 100% to blame for this. But it was certainly a factor because we could not have had the massive inflation that we've had otherwise, right? And that inflation is a big reason why wages stagnate. Inflation has outstripped real wage growth. And so if we understand the Cantillon Effect, we can understand what happened, right? When you have a system of elastic currency where money and credit can be created at will, it does not distribute itself evenly, all right? Instead, the newly created money flows first to those who are standing closest to the point of where the new money enters the system. So that flows to the banks, to the financiers, and to the interest groups that have the closest ties to government. So the men who receive the new money, and I say men and women, the people who receive the new money first, they get to spend it before prices adjust to account for the extra money in circulation. Then that new money kind of trickles down into the economy after prices have risen, right? And so that's why wages did not keep up with productivity. So it's an extraction mechanism. We've been working inside of an extractive economy. That's what fiat money does. That's what financialization does. And so this is why I've been fascinated by what Treasury Secretary Scott Bessent and new Fed Chairman Kevin Warsh, what they've been signaling, right? They appear to be repudiating the Keynesian economic policy that has enabled and kind of ran cover for the financialization of the American economy over the last 50 plus years. Right? And we talked about that in our previous two episodes. So I will leave you with this today. Guys, I think it's time to get back to real things, real assets, real relationships, real production. That's the thread running through this whole episode and really honestly through the whole show here. And now, you and I can't fix the concentration of ownership in the three passive fund giants, BlackRock, Vanguard, State Street. We can't fix that, but we don't have to contribute to it. We can be more intentional with our own investments. And that's exactly what the Phoenician League blueprint is built for. We've got a 5-pillar framework that's designed to create a personal investment architecture that you own, that you control. And so, friends, I'm very confident in saying that the age of paper wealth is over. But as we've discussed previously, the entire kind of financial planning model, that was built for the era of paper wealth, right? They haven't updated their playbook. So if you're ready to learn about a new playbook, one that was purpose-built for this new economic climate that we're in, I'd like to invite you to join us for our next Phoenician League strategy session. And it's coming up on Wednesday, July 22nd, and we're going to get started at 7 o'clock p.m. Eastern Time. All right, so the session is free and it's open to all. July 22nd, 7 p.m. Eastern. Just go to Phoenicianleague.com/session for all the information. All right, so that's it for me today. I'll see you next week. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at Phoenicianleague.com. We often send out detailed written analysis on the various investment opportunities and the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at Phoenicianleague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.